Support for today's episode comes from Amazon. Amazon is working toward a carbon free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. Sustainability Soundbites energy coverage is sponsored by Amazon. Visit the link in our show notes to learn more about Amazon's spotlight on energy. Who owns energy contract risk? No one signed up to own. Corporate energy contracting has become a cross-functional exposure without a natural single owner. When load forecasts change, prices move, or a facility closes, responsibility for the resulting risk can fall between functions that each did their own job correctly. Corporate energy contracting has become a cross-functional risk without a natural single owner. Procurement negotiates the contract, facilities forecasts load, finance approves the exposure, sustainability influences the energy source, and legal manages the terms. But when load forecasts change, market prices move. A facility closes, a project is delayed, or a PPA becomes economically unfavorable, responsibility for the resulting exposure can fall between functions that each did their own job correctly. That makes are companies managing their energy contracts correctly the wrong question. The better one is who is accountable for the total portfolio when each function owns only one piece of the decision. Procurement owns the transaction, not the load forecast. A contract can be negotiated well and still become a bad corporate position if demand changes materially after signing. Procurement's job is to secure competitive pricing, reasonable terms, and a creditworthy counterparty, and a well-run procurement process can do all three. What procurement typically cannot do is guarantee that the load the contract was sized against still exists 5 or 10 years later. Fervo Energy's own securities filings make the underlying uncertainty explicit from the seller's side. The company tells investors that project delays or cancellations by significant expected off-takers, including data center facilities, could reduce or slow demand for electricity relative to current expectations, alongside evolving technology, efficiency gains, and shifts in regulation. That same uncertainty runs in both directions. A buyer's own facility plans can move as fast as its suppliers, and the contract signed to match one version of the business does not automatically match the next one. Facilities owns consumption, not the hedge. Plant closures, expansions, electrification projects, and new data center loads can alter the economics of contracts negotiated years earlier, often without the team managing those operational changes ever seeing the financial instruments sitting behind them. Facilities and operations teams are measured on uptime, cost per unit, and reliability, not on whether a 5-year-old power purchase agreement still matches current consumption. Verdantic's 2026 Corporate Energy Leader Survey of 350 enterprise energy decision makers found that 40% considered it highly likely, and another 40% somewhat likely, that their organization would redevelop its approach to renewable energy procurement within 2 years, a signal less about dissatisfaction with deal terms than about portfolios that have outgrown the operational assumptions built into them. Finance sees the dollars, usually after the exposure exists. Long-duration PPAs, fixed-price supply agreements, hedges, and termination provisions can create financial consequences that do not behave like ordinary procurement contracts. And finance frequently encounters that exposure only once it shows up in a budget variance or a leverage calculation. Investors have started pricing that disconnect directly. PwC's 2025 Global Investor Survey found 67% of respondents would at least moderately increase investment in companies actively managing energy demand and infrastructure risk. Yet most corporate ESG and financial disclosures still cover energy consumption, renewable percentages, and emissions intensity, rather than interconnection queue positions, PPA settlement exposure, or portfolio-level hedge coverage. Finance can approve an individual contract cleanly and still have no mechanism for aggregating what a dozen individually approved contracts add up to in combination. Sustainability sits alongside that gap without closing it. Renewable procurement decisions can simultaneously serve emissions targets and create basis, volume, counterparty, curtailment, or project development exposure that has nothing to do with the sustainability outcome the deal was meant to achieve. A sustainability team can hit its renewable energy percentage and still be sitting on a contract with meaningful financial risk, because the metrics that measure program success and the metrics that measure commercial exposure were never designed to be the same dashboard. The contract has an owner, the risk may not. An organization can have perfectly clear signing authority and still have poorly defined risk authority. Someone approved the PPA, someone monitors utility bills, someone updates the load forecast, someone reports renewable energy progress, someone manages the developer relationship. None of that guarantees that anyone is continuously asking whether the company's combined energy position still makes sense, given how the business has actually evolved since signing. Each function can point to a person who owns their piece of the decision. Almost no organization can point to a person who owns the portfolio as a whole, and that gap is not a failure of any single team. It is a structural byproduct of how energy decisions get made, sequentially by different functions at different times, against assumptions that were accurate when each decision was made and increasingly inaccurate by the time the next one is. That connects directly to a separate but related problem. Treating a contract's renewal date as the moment to think about market exposure is itself a form of market timing. Active contract management addresses the timing question. It does not answer who inside the organization is responsible for asking it. If active management is now necessary, the next question is unavoidable. Who actually owns that responsibility once the contract is signed and the business underneath it keeps changing? Executive teams are increasingly discovering this problem the hard way. Capital gets committed before energy is secured, expansion gets approved before permitting variance is modeled, and the sustainability targets get announced before procurement contracts adjust to match them. A sequencing problem that used to create inefficiency and now creates measurable earnings variability. The pattern is rarely outright disagreement between functions. It is timing. Each group makes a reasonable decision with the information available to it, and the combined position only becomes visible once results compress or a market shift exposes what no one function could see on its own. What the executive question actually is. The answer is not a particular organizational chart. Some companies will centralize energy risk under Treasury. Others will build a cross-functional energy risk committee. Others will keep the work distributed, but add a continuous reporting layer that forces the pieces to be viewed together on a regular cadence. What matters is not which structure a company chooses, but whether the company can answer a specific question. Who has the authority, the data, and the responsibility to look across procurement, operations, finance, and sustainability, and decide whether the company's energy contracts still match the business they are supposed to serve? Most companies can name who signed the contract. Fewer can name who is accountable for knowing, at any given moment, whether that contract still makes sense. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.